Hey everyone, hope they're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, and see what is going on. If you want to follow me, it's at Riskreward Finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these topics, sharing opportunities with everyone in the community, answering questions on the weekends, giving midweek updates during Wednesdays. If that sounds interesting to you, use that special coupon code for some savings on both the monthly and yearly membership. Market Sniper, he says monetization of own debt. Where are all those foreign buyers? Quick, someone call BJ and GG. Shortage of UST, United States Treasury guys. And again, the Fed bought 14.8 billion worth of 10-year bonds today. This is on top of the 20 billion it bought yesterday. And I think that's where the quote yesterday when I did that update, nothing can stop this train. I think that's what she is referring to, Lynn Alden, is all this bond buying. Now, again, this may not be quantitative easing. They're still buying bonds. It might be a rollover of bonds on the balance sheet where they take that money and roll it back over into buying more bonds. But yeah, there must be a huge shortage that some of these guys are talking about. Oh, there's a huge shortage for treasuries. No, there isn't. What are you talking about? There's a huge shortage. Why do you think interest rates are going up? Yeah, huge shortage, bro. Huge. Hearns Co. Somewhere, someplace, natural gas appears to be booming and business cases discussed. Canada, not so much yet. ACO buried under $2. It's like the pre-TMX expansion for Canadian oil when watching everyone else get paid. So Henry Hub and ACO have this big price disconnect. And that disconnect will close once you get takeaway capacity out of that area. The Trans Mountain Pipeline here, the TMX expansion, that's what's bringing the oil price higher for Canada, is that pipeline. We have LNG coming soon into Canada for natural gas. So it's coming. It's coming, and I'm sure this could move on up over time once everything gets put in place and they get takeaway capacity and some pipelines going. Holy smokes, I knew prices were going down. I didn't realize it was to this degree. Per CNBC, gasoline minus 10%, tomatoes down 8%, lettuce down 5%, TVs, car, truck rental down 9, dishes, flatware down 11, and the list goes on. And there's that list that they are potentially referring to. All I'm going to say is this, guys. I don't see it on the stuff that I buy. Mine is still going up. Eggs are still the same price that I've always paid. I would say the past 6 months, they went up from a previous year ago. Pistachios are up. Peanuts are up. Ribeye steak per pound is up. Um, Everything that I purchase, peppers is up. Avocados are up. Everything I purchase is up. Gasoline is not higher than a year ago for me. I would say that it's roughly flat. I don't think it's down 10%. Gas here has been in the upper $2 range probably for about 6 months to a year. Tomatoes, I don't think, I think they're sideways. Lettuce is sideways. I don't, in all honesty, I have seen nothing go down. Nothing. Zero, zilch, nothing. I pay attention. So I do most of the shopping. I do a lot of the grocery shopping. Even I do that during mornings, kind of late morning. And uh, apples are up. They have definitely not gotten cheaper. They've gone up. Everything that I purchase is up. I do not believe this. I think that this, whatever this is, this does not match what I'm doing. Not by a long shot. Now, tomatoes might be down. I don't really buy tomatoes. I'm not a big tomato guy. I buy some lettuce, but that's all been flat. But I would say that whatever I do, I must be doing it wrong because I don't have anything that's gone down. Nothing that I can think of. Everything has gone up. There's so much more risk than reward out there right now. It's astonishing. I think it depends on what you're looking at. If you're looking at the commodity sector, I think that the risk reward is fantastic, absolutely fantastic, and I'm seeing bottoming patterns all over the place. For other people, if you're looking at maybe like expensive financial assets, then yeah, it looks kind of risky out there because you could see some rising wedges. You could see things that maybe could roll over. It's possible. So maybe that is the risky portion of the sectors and the area in the stock market. But commodities look fantastic. I mean, they look absolutely stunning. Platinum squeezing up into a corner. That looks ready to just rip. Lithium doesn't look too bad. Oil looks like it's bottomed. We've got uranium heading higher. Fertilizers are heading higher. I see all sorts of stuff that looks good. So I don't see it the way that maybe other people do, and maybe they don't look at charts, and maybe they're not looking at money flows coming into the market and people positioning. Uh, when I look at the commodity area, I think everything looks good. I could just randomly throw crap at it and probably do all right. There are some sectors that are a little bit weaker than others, but I mean, even home builders don't look that bad. Maybe the worst is behind us, maybe not. It's always tough. It's always tough to know for sure, and no one will know until things have bottomed and the bottom is behind us in the rearview mirror. If you're trying to buy the bottom, you gotta have to stick your neck out a little bit and say, you know what, I know I could be early, but that's what every bottom feels like. It feels like, oh, it could be too early. And that's what the bottom feels like. There's maximum uncertainty at bottoms. The front running of tariffs has led to a huge buildup in excess inventories. This is potentially deflationary if these inventories have to be liquidated at reduced prices. The rush to buy ran up prices, pressuring inflation pressures. Now it will run in reverse, according to Lance. And I'll just say this: prices going up or down based off of this is not inflation. Inflation is the increase of the money supply, and deflation is the decline of money supply. So you can have some prices go down, but still be in an inflationary area. The Federal Reserve and the governments want you to be focused on prices, less focused on why those prices go up, which is just money printing by them. So we've got M2 money supply going up. We have inflation. What this guy is saying, even if some of these goods could go down, depending on what it is, that's not necessarily deflation. That's just prices going down, not deflation. It's not a deflating thing, but there it is. And this is the price run up of people buying a bunch of stuff before that comes. I don't know. I've been looking at a lot of things that I purchase just to see if it's made in China. So I'm looking at like stuff that I use on a daily basis. I'm looking at face wash, body wash, toothpaste, like just random stuff, and nothing's really made in China that I consume, I guess, because those things were not made in China. Some were made in Canada and some other areas in like the United States, but I didn't see anything. But again, maybe it's imported from China, gets put a made in USA label on it and all that, and maybe something like that is possible, and where the prices might still go up. Tough to say, because we would do that where I would manufacture stuff. Um, Depending on what percentage of the item is manufactured in the United States, if you import 20-30% of it, it's still made in USA. If the rest is made in the United States, so it really depends on how complicated the thing you are buying is, and you can still have things made in other countries and put a "Made in USA" label on it. Coming down, rock bottom entries. The TSX Venture has broken out of a multi-year base. Keep this at the forefront of your market bias. We're in a raging junior miner bull market. There we are breaking higher today with increasing volume, looking real good for this 10-year inverse head and shoulder pattern on the S&P TSX Venture Composite Index. So that looks really good. I like the big, strong drive up, the small selling pressure down into another shoulder, head, shoulder, and the breaking of that smaller inverted shoulder. So this is a dream within a dream. So your dream is the big shoulder, head, and shoulder. Then you have another shoulder, head, and shoulder, and then the break of that shorter pattern, which hopefully breaks into a larger pattern and then breaks the bigger pattern. If that happens, we're coming from pretty low area, 680, where we could get into like the 6, 7, 8,000 range way up there in some, many years time, but we could go into a raging bull market. A lot of this is kind of a gauge of what the junior miners could do, because the junior miners are all part of that area there. It's they're a part of this index, so that looks good. TSXV, clear breakout in the junior resource sector ongoing, bodes well for incoming re-rates. So we're breaking out. You can see that green breakout here above all that resistance. So that looks really good. It's a big deal, guys, because it's an indicator of what's going on. And I hear a lot of people, oh, well, we could go down, the stock market could crash. This is not what it's doing. This is your signal right here. That's your signal to get on it. In my opinion, it's not, oh, I'm going to wait for the S&P and all this stars to align where everything goes up together. Maybe the S&P goes up. Who knows? But this looks good. It looks very good. The moment of truth for the S&P 500. Will this price analogy continue to work? And he's got a double bottom here potentially. I don't know. We'll have to wait and see. 98 was the beginning of the commodity bull market, and maybe we've got something similar in 2025, maybe. And I don't know what this is going to scribe out in the short term. No one knows, but it is a possibility. It's possible. OPEC oil output edged lower in April despite a scheduled output hike taking effect. A Reuters survey found, led by a cut in Venezuelan supply on renewed U.S. attempts to curb the flows and smaller drops in Iraq and Libya. So even though we're supposed to go higher, maybe they're just papering things around. What if they don't actually increase supply? What if this was all one big scheme to reduce oil prices here in the short term? Imagine if they don't produce anything more, but yet we've got a whole bunch of CapEx pulling on back in the shale area. What if we get 500 to 1 million barrels a day lower in shale, and let's say we barely get anything more out of OPEC? That's bullish. In fact, we've been running pretty large deficits during build season. What if they don't have the spare capacity that people have baked into this cake? I think the risk is to the upside, not the downside, potentially over the next, say, 2 years. Everyone is bearish, therefore they are crowding into Bitcoin, known for its safe haven properties. He's joking, obviously. It's the Madoff investment hypothesis, 100% guaranteed to explode an entire generation of Ponzi acolytes. There we go. Maybe it's a double top. Maybe we're doing this second market crash deal there, and then we head lower. I don't know. This is Bitcoin to Dow transports. It's been moving on up there in the short term. In 2023, Flow predicted a Permian peak at 6.3 million barrels per day, and the EIA has us at 6.4 million barrels. Oxy CEO is now saying Permian could plateau sooner than expected, after saying 2027, 2030 at CERAWeek. Yes, we had an exogenous event, but this was predictable by exhaustive, large-scale analysis on future drilling locations. The sky isn't falling, but the situation is changing. So did Vicky not understand the situation, or did she move the goalposts? Both are scary, but as investors, you have to understand that goalposts moving is part of the game. You are a frog in a pot. It's your job to know what the temperature is. If Permian production drops, I'd expect Vicky to come back and say, see, I told you this was going to happen. This is CEO 101. It's time arbitrage. You are being arbed constantly. You need lead time to take action. Permian production, excluding deferred targets, could potentially be peaking and rolling over in 2024, and then the peak here for daily output optimization could peak here at any second. That's what we're looking at there. I'm not waiting. I'm buying, and I'm going to hold on through this. If this peaks here, I don't know where we're going to get large-scale amounts of oil in the world to basically increase production over time. I think we can maybe hold flat for a little bit. As demand starts to gap above us, price will go way up. Now, we don't have a ton of Dukes, drilled uncompleted wells. We've kind of eaten through a lot of that inventory. So this is going to be a fun ride. We're going to have to start drilling again. And just because we drill doesn't mean that this will go back up. If it's geology constrained, we will still go down, just like the 1970s. We drilled like heck in the 1970s, and guess what happened to production? Still went down. Now, I'm not saying that if we drill like heck that we would necessarily go down. I'm saying it's a potential outcome. It doesn't mean that, I mean, we could go, maybe we could plateau this longer and bring it out. Maybe. It all depends on what tier wells they want to drill and how much capex and how much we drill, and maybe it doesn't matter how much we drill. There's going to be a point where it doesn't matter how much we drill, and we will go down in supply, and that it will be the scariest thing that anybody has seen in this world, because everything is built off oil, everything, and the value of oil, the true value, will come out when that occurs. Imagine how valuable oil is in man hours per barrel. I mean, it's ludicrous, the things that we've been able to do in society with oil and harnessing that amount of energy in equipment and machines. I would suspect that 60, 70, 80, $100 a barrel is far too low if we were to get a decline of, we'll say, the entire world of oil. Maybe we could substitute it with natural gas for a while, maybe. But I think that's supposed to peak in 27, 28, 29, 30 as well. So we're coming. We'll see what happens. Eric Yoon says, I forgot to tag Francis Hunt, the market sniper, in my last post. Francis is one of the best out there. Here, Francis explains that the Federal Reserve can't cut rates because no one will accept those lower rates if the Fed cuts. This is the real reason why the Fed is holding rates steady. Thank you, Francis, for your excellent take. Yeah, that could be the case. I used to have this mental illness where I thought logical arguments would change someone's mind. I thought that was pretty funny when I first read it. I was like, man, that's actually pretty good. A lot of people do not use logical arguments anymore, and they don't change their mind. So the best thing you can do next is stop arguing with them. Just stop. I think there's a quote that says, stupid people will drag you down to their level and beat you with experience. That's, I think, Mark Twain maybe said that. Kevin Bamborough says, amazing how quick URNJ pays. The move from $63 a pound to $70 a pound and a shift in sentiment has resulted in a 40% plus rally in a few weeks. That's a great year right there. Clear demonstration of picking spots to load up and grab fairly easy profits, risk reward. Meanwhile, SILJ peaked in 14s and is back to the 12s. GDXJ 65 and struggled from there. Very profitable shift from gold and silver to uranium. With this strong rally in uranium, the shift back of some capital to SILJ from URNJ makes sense to me. I still think URNJ breaks to 20, but risk reward feels to me like it favors silver again. I'm not sure if I'm in that camp. I actually own both SILJ and URNJ in pretty big quantities. There's probably a handful of ETFs that I own, and I'm going to ride it, guys. I'm not going to try to time it. I think Kevin's trying to time it here, but I think URNJ still has a long way to go up. URNJ generally goes up with other energy, and energy looks good. So I'm not in any hurry to sell anything. The big moves is where the big money's made, and I think I think uranium's going to go way up during this bull market. So I've got a big chunk in there. I'm going to let it ride. Same with SILJ. I think SILJ is a really good one, and if SILJ outperforms in the short term, so what? I own it. So that's the way I view it. Nick says, as the OPEC spare capacity overhang decreases and inventories continue to draw, markets are going to have to make some difficult choices. And this is in respect to Josh Young. The latest global petroleum inventory figures from Morgan Stanley and the various data providers they cite are even more positive than the recent numbers from Platts. And this is the total observable inventories on the low end. Well, what if they bring back oil and we continue to draw down inventories below this range? That would be interesting. Be very interesting. Here's another one from Grady. This is XAU divided by gold. It says gold miners are bottoming very big picture versus gold. It means gold miners are about to outperform gold in the long term. Pointing out that gold miners have underperformed gold very big picture historically does not really have any meaning. Then this is says then is then, now is now. Profiting from precious metals miners is all about timing. And if you get the timing right, miners outperform the metals by a mile. And this here is a falling wedge that we've broken out, and we could potentially be heading higher. He says ratio charts are about relative strength. They compare the performance of one stock relative to another, and they are a useful additional tool for figuring out sector direction. The pink breakout will also mean a new high after a blue breakout, i.e. blue breakout confirmation. If we start to break higher here, we could see a big outperformance of gold and silver mining companies in relationship to gold itself, maybe even a 6.4x if we get back to the top here. And that's outperformance against gold. Here's another one, big picture view for gold here. He says, set it back in 2002 at the blue breakout, plus back in early of 2024 at the blue breakout. For heaven's sake, do not miss this historical bull market. This is the third bull move, which will kill the present global monetary system. The largest 3 drives up move I've ever seen. The first drive was the 1970s. The second drive was the 2000s to 2011. And here we are with another drive higher for the third move. And in his opinion, it's going to break the global monetary system. And every single time of these big pulls, they were commodity bull markets. Someone name me the last thing they bought from the UK. Fair. That's a fair assessment. I don't know anything I bought from the UK. I really don't. So a tariff deal on UK, that's just great, right? North Star, silver is a sleeping giant. In the next leg of this precious metals bull run, after the ongoing correction, it should, at a minimum, outperform gold by 150%. This is a big squeeze here into the corner, and we'll eventually break to the upside where silver priced in gold, where silver is going to outperform gold. It is coming. 5 reasons for a new oil bull market. Depletion, including the Middle East. Global oil demand will continue to grind higher. Oil prices are falling due to financial oppression, not demand. When U.S. shale peaks, the world peaks. Totally agree with that. Oil incredibly undervalued versus stocks and bonds. Yeah, he pretty much nailed it. And I would also say that we're at an incredibly large valuation gap of oil versus gold. Gold's our leader. Gold breaks out first, which it has, and oil will follow. So I do think that will work its way through. The stock market is a device for transferring money from the impatient to the patient. Got to keep that in the forehead there. Keep it in the forehead. If investors can think of an asset class and say, oh, for that, there's no price too high, that's one of the greatest indications of a bubble. Yeah, crypto. Coming down, we've got the 25% gold, silver, platinum, and palladium ETF. And he says that's a strong long-term picture, says Uselink. And this is without palladium and platinum doing any lifting, as we are moving higher in that for the group of 4 precious metals moving on up. Looks good. Jim Etzel, he says, unanticipated by those who don't know, oil inventory surge. This from Mike Rothman today. While the figure is preliminary, we estimate total petroleum stocks in NA rose by 3.2 million barrels last month. This compares with a normal April build of 20.5 million barrels. And last year, we had a 34 million addition. There is no inventory surge. Demand is strong. U.S. production has peaked. Oil prices must rise. Pretty strong there. I like it. But that's all I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Use that special coupon code. We do have a Saturday question and answer session. If you can't make it, it's always uploaded to the website, so you didn't miss anything. All right, guys, that's all I've got for today. We'll catch you next time. This is Finding Value.